Hello, and welcome back to our second lecture portion dealing with statement of cash flow. Now, in this video, I want to discuss how we actually put together the operating activities. Okay, so we're looking at the operating activities section, and if you remember from the previous video, or the one before the last one, we mentioned that there's two ways to put together the operating activities. The only thing we're going to focus on is the indirect method. Okay, so keep that in mind. Now, in order to prepare the statement of cash flows using the indirect method, we need three types of information, or three sources of information. First, we need a comparative balance sheet that shows the changes in our accounts, right? That's why we need it, because we're going to see, did an account increase, did an account decrease, okay? Second thing we need the current income statement. And then the third thing we need is any additional information, meaning, did we make any, or did we have any significant non-cash investing and financing activities, okay? If we did, we need that information, okay? So let's see how to, Let's see how to prepare the statement of cash flow, okay? First thing, step one is we need to determine the operating activity section, okay? So we need to start off with the current income statement, and we need to take our current net income, right? Now, remember, our net income that we calculate, or that income statement, that's based on the accrual method, right? And remember, accrual says we recognize revenue and expenses when it's either earned or incurred, not when cash is collected or distributed, okay? So that's number one, right? We have this issue where we need to take statements that are done via the accrual method, and we need to turn them into the cash method. Super easy to do. It really is. We're going to go through these steps. Super easy to do, okay? So that's number one. Number one is we got to start off with our net income, okay? And in order to do that, what we need to do is we need to take the current year's income statement, just pull off the net income. Then we need to look at our comparative balance sheet, okay? That's number two. We take our comparative balance sheet and we're going to look at accounts, specific accounts, and say, okay, did they increase or did they decrease? Step two, right? We need to analyze any changes in any non-current assets and liabilities, okay? The reason why is we're going to use the non-cash assets and the liability accounts to determine, do we have any investing and financing activities that we need to report on, okay? And also, too, we need to look at that additional information to see if there's any non-cash transactions, okay? So in order to do this, again, we got to go to our comparative balance sheet, and we need to also grab that any additional information that we may have, and we need to determine what are the effects on cash, okay? And then the third thing we need to do is we need to take the net change in the cash that we calculate on the statement of cash flow, and we need to then report what's the difference in our cash, right? That's basically what we're doing by preparing the statement of cash flow. We're showing how cash changed from the beginning of the year to the end of the year. And then finally, we're really proving that cash balance, okay? Now, we're going to use the indirect method, right? So why would a company want to use an indirect method? Well, number one, it is, as you will see, it is super easy to prepare. It's also less costly, okay? Second reason is it really focuses on the difference between net income and net cash flow from those operating activities, okay? So looking at the indirect method, right, the first thing we need to do is grab our current income statement, which we have here, right? And notice it gives us all our expenses, right? All these expenses were calculated on the accrual basis. We don't care about that. We want to know about cash. We want to know how cash changes, right? So notice we have our net income. And incidentally, that's the first place we start, okay? Then they give us an example of the current or the comparative balance sheet, right? So notice they show cash, right? Cash changed from 2016 to 2017. Cash increased by $22,000. Look at accounts receivable. Accounts receivable decreased from the beginning of the year to the end of the year, right? Decreased by $10,000. So we do that, we go through that through all our accounts, right? Specifically all our asset accounts, okay? Oh, sorry. Then we do the same thing for our liabilities. We have our accounts payable, we have our income taxes payable. We have our look at the bonds, right? Bonds payable. It was $20,000 at the beginning of the year. At the end of the year, it was $130,000. So that means that throughout that year, by issuing bonds, specifically $110,000 in bonds that we issued, it's probably a source of cash, right? Look at common stock, right? We issued common stock. Right? That has an impact on our cash. It increased by $20,000. Okay, and then look at retained earnings. Then they give us some additional information, right? Depreciation expense was comprised of $6,000 for the building, $3,000 for equipment. Okay, cool. Company sold equipment with a book value of $7,000, cost $8,000, less accumulated depreciation $1,000. Looks like we got $4,000 in cash for that. That's important. Okay. So what we need to do, and this is very, very, very important. Okay, so I would definitely write this down. In fact, we're gonna start off with how do we prepare just the operating activities, right? So the first thing is we start off with net income. Okay, that's number one. We take our net income and then we need to add back any non-cash expenses. Okay, what are our non-cash expenses? Well, that's our depreciation, our amortization, our depletion. Okay. Then the third thing we need to do is we need to either deduct any gains or we need to add losses, okay? Why? Because we're worried about the cash flow, right? Any gains, any losses that we incur as a result of selling equipment or, PP&E, anything like that, right? Remember, we already take care of the cash flow from that sale as a investing activity. Right? The gain or loss is reported in the statement or in the operating section. Okay? That gain or loss really doesn't have it. We use it in accrual to figure out what our net income is, right? But the cash flow really isn't there. We've already accounted for the cash flow in our investing activities, okay? So that's number three. The fourth thing we need to do is we need to analyze any changes in our non-cash current assets and current liabilities. Notice it says non-cash, okay? Whenever you do the operating section, if I see cash and you include the change in cash, that is not right, okay? The whole statement of cash flow is trying to prove that cash balance. So we do not put cash, the cash account, we don't analyze that now, right? We're only analyzing non-cash, current assets and current liabilities, okay? Okay? So make sure you have that in your notes. And I'm even taking notes with you, okay? So operating activities. Which an example of cash flow from operating activities? Well, payment of cash to lenders for interest. We know that, right? We talked about that in our last example, okay? So we're going to walk through those notes that I told you to take down. Start off with net income. Add back any non-cash expenses. Deduct any gains or losses. Analyze non-cash current assets and current liabilities. We're going to do that entire thing right now through these PowerPoints, okay? So notice the format, right? We start off. Bear with me here for a second. Let me see if I can do something. Where is it? I don't think I get it in this section or in this view. There's a way to... in your PowerPoints, you can make your mouse light up, but just follow along with me, all right? So I'm in the middle of a slide here. First thing we start off with, cash flow from operating activities. Cool. That's our title, right? Then we start off with net income, okay? And we plug in our net income, $145,000. Then underneath that, we say, okay, here are the adjustments we need to make to reconcile net income to net cash. Specifically, those activities that are provided by operating activities. We add back our depreciation expense, $9,000. Okay, where'd we get it from? We pulled it from the income statement. Okay. Any loss or disposal, right? We need to, if we, anytime we have a loss on disposing of PP&E, we need to add that back to the net income, again, within that operating section. Any gains on disposal, we got to deduct from net income in the operating section. Okay? And here we go right here with that, right? Then we have loss on disposal of equipment, $3,000. It's a loss. We got to add it back. So look at our cash. Our cash is going up, right? Or let me rephrase that. Net cash provided by operating is increasing. Okay? So then we have to look at any changes to non-cash current assets, right? We're going to look at our accounts receivable, right? Now this is key. When the account receivable balance decreases, right? Cash receipts are higher than the revenue earned. That's under the accrual basis, okay? So what we need to do is we need to add to net income the amount of the decrease in accounts receivable, okay? So basically, we can sum that up in a rule that says if current assets decrease, we need to add that to net income, okay? So put that in your notes. Current assets decrease. I don't care what the current asset is. Well, let me rephrase that. It has to be non-cash. So I don't care what the non-cash current asset is. If it decreases, we need to add that change to our accounts or to our net income. Okay. So notice we say decrease in accounts receivable, 10 grand, right? That was the change. Our accounts receivable decreased, so that had to have added $10,000 of cash. Okay. We do the same thing with inventory, right? What happens if inventory increases? Well, if inventory increases, what are we doing with cash? Well, we're spending cash, right? So what we're going to use for that, or let me rephrase that. What that means is when the inventory balance increases, the cost of merchandise that we purchased is going to be higher than the cost of goods sold. And that makes sense, right? So the cost of goods sold, again, does not reflect any cash payments made for the merchandise, right? So we can't use cost of goods sold on the statement of cash flow, right? What we need to do is look at how did our inventory change, that $15,000 change. We need to deduct that from net income. So here's another rule that we have. If a current asset increases, we have to add it to net income. Okay, I'll say it again. Even though it's a recording and you can rewind it, I'll say it again. When current assets increase, or let me rephrase that, when non-current assets increase, we need to add the change to the net income. Okay, so look, here we go right here. Going back to the statement of cash flow. Increases in inventory. Well, it increased by $5,000. That means that throughout the year, we must have a net amount. Our inventory increased by $5,000. Okay, so we need to add that back. Okay, when we're looking at prepaid expenses, right? Prepaid expense is a non-current asset, right? When the balance increases, what happens? Well, the cash paid for the expense is going to be higher than the expenses that are reported on the accrual basis, okay? So what do we need to do? We need to deduct the decrease from net income to arrive at the net cash provided by operations, right? So look what it says. If prepaid expenses decreases, report expenses are higher than the expenses paid. Okay? So, look at this. Increase in prepaid expenses. What was that rule I said? If current assets increase, we need to add that amount to net income. That's what we're doing here. Okay? Then the next thing we need to look at are our accounts receivable, right? So what happens when an accounts receipt, or let's just look at accounts payable. Accounts payable increases. What happens? Well, the company received more goods than we paid for, right? That's under the accrual basis. Okay, I get that. That increase is added to net income to determine what our net cash is provided to, or provided by operating activity. So we have another rule here. Current liabilities, right? If current liabilities increase, well, then we have to add that to the net income. Okay? And then look at the second one. They use another payable, right? Income tax payable. What if that goes down, right? What do we do? Well, if income tax payable decreases, the income tax expense that we have reported on the statement or the income statement is actually going to be less than the amount of taxes paid during that period. So that decrease is subtracted from net income to determine what net cash was provided by the operating activities. So we have another rule. If current liabilities decrease, we need to subtract from net income. Okay? So look, here we go. That increase is added, the decrease is subtracted. So just as make sure you have it in your notes, right? When we're focusing in on analyzing these non-cash current assets and current liabilities, decrease in a current or a non-current asset is added, right? If we have an increase in a non-cash current asset, we subtract. Okay? And conversely, it's the total opposite for liabilities. If we have an increase in accounts payable, we add it. If we have a decrease in accounts payable, we subtract it. Okay? So right here, and this is actually pretty nice, tells you what we do, right? We start off with net income. Any non-cash changes, right? We got to add back any non-cash charges, So the depreciation, amortization, depletion expenses all get added back, right? Then we got to look at our gains and losses, right? If we have a loss on disposal of a plant, we add it to net income. If we have a gain on disposal of plant assets, we have to deduct it, okay? The changes in current assets and current liabilities. Well, if we have an increase in a current asset, we have to deduct it or subtract it. If we have a decrease in a current asset, we add it. looking at the current liabilities. If we have an increase in the current liability, we add it, that change. And if we have a decrease in current liabilities, we subtract it. Okay? If I were you, I'd put this on a note card and I would memorize it. Okay? Those are that's the key to putting together the statement of cash flow, is knowing what do I have to do. Okay? That's pretty much it, right? We can memorize it, or we can go back and we can study our slides and the logic behind it, right? Prepaid expenses. Well, the balance increases. Okay, well, what's that mean? Cash paid for expenses is higher than the expenses that we report on the accrual method. Okay? So because we have less expense, but we're worried about that cash flow, we paid for that expense, we prepaid it. That means we have cash going out. That decreases our cash. That's why we have to add it. Okay? And we can go through that same logic with the current liabilities, increases and decreases in the current liabilities. Same thing with the current assets. Any increase or decrease, we could say, okay, what are we receiving? What are we recognizing? And what does that look like on a cash basis? That's really what we're doing here. Okay? Don't worry about the do it. I'm going to come back and hit the investing and financing activities later in another video. The reason why is because it doesn't matter what method you use, direct or indirect. The investing and financing activities are going to be done identical. Okay? It's the operating activities section that you really got to learn. Okay? All right, so tune back in for our next video where we actually run through a demo of how to put together the operating section using the indirect method.